Welcome to the Remarkable Retail Podcast, our Season 7 debut episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this episode, we take you onto the stage with us and our good friend of the pod, Simeon Siegel, Managing Director, Senior Analyst, Retail and E-Commerce for BMO Capital Markets, live in New York City, kicking off the Lead Innovation Summit in mid-July.
Yeah, it was such a fun time. Well, first time, I think, for both of us at the Lead Innovation Summit. So that was a great event to check out. Ran into lots of interesting people, heard lots of interesting content, and getting to be on stage with the two of you was a ton of fun. I think standing room only, and got things off to a good start.
Yeah, and shout out to all the great people came up and said hello to us. We had a little pop-up podcast studio there. You'll be hearing some interviews from that said hello and they liked the pod. It really means a lot to us because we don't, we don't always know who's listening to the podcast. So thanks for taking the time and saying hello and saying great things about what you're hearing. So to that degree, we want to keep doing more. It's our first episode of the brand new season, and it's like a back to school for us. It's actually one of my favorite times of the year still. I haven't been in school in a little while. We had a great season 6. It was action-packed, conferences and bonus episodes. Now, for season 7, let's talk about what the listeners can expect.
Well, I think to a certain degree, we don't need to fix what's not broken. We had such a great season. I was just looking at some numbers. Our downloads were up 62% year over year. So great. Thank you. Great momentum. And continuing this balance of really showcasing the remarkable leaders at remarkable retail brands, part of the formula. I think we'll probably end up with a fair number of episodes without guests, where we get to just riff on what's going on. Those episodes tend to do pretty well. So that seems to be working. I think a couple of things, we had a little bit of fun with our trailer talking about I love you, but you're not serious people. As much as we did that because we love Succession, and I think it's a fun thing to do, I do think that this fundamental notion of needing to get, not every retailer, but many retailers needing to get more serious about transformation, going beyond this idea that incrementality is likely to be what's going to make you successful. I think we'll be pushing against that. That'll give me an opportunity to preview some of the material from my next book, which we'll be talking about a little bit more as we get closer to release date, but that's still a ways off as I'm deep into the revisions right now.
Yeah.
I think there's lots to, retail is always pretty dynamic. So sometimes we kind of know what we want to talk about, and then things emerge as the days go on.
That's for sure. All right. Well, let's get into the news. I mean, the news on this episode is a bit of a catch up. I mean, it's summer, so it's not like the most active period, and some of these things are a little bit aged. But as you think about what's transpired in the past, I don't know, kind of almost like about a month. What are the highlights for you? What should we talk about, and what have you been thinking about?
Well, there are a couple things, I guess, more of the same in terms of what's going on, big picture in the economy. A couple days after this episode comes out, we'll know what the next move is from the US Federal Reserve on interest rates. And of course, there's a lot of speculation throughout the world as to the direction of economies. I guess the good news generally continues to be inflation coming down, but a lot of other things, whether we're talking about the UK or throughout Europe or US or Canada, still point to the economy running a little bit hotter than generally people would like. So I think that'll just be a persistent theme. Specific to retail and specific to the U.S., we have this looming UPS strike. And I think it'll also be the case that a few days after this episode comes out, we will know whether that strike will occur, which could definitely wreak some havoc. I will say I'm a little bit sympathetic to the UPS drivers being down here in Texas where it's 103 degrees.
There's no air conditioning.
One of their key demands is air conditioning in the trucks.
I'm like, what? You don't have air conditioning in the truck?
Yeah. When I heard that, I was like, oh,
come on.
Got to be kidding me. So I would hope at least they could agree on that. I know there are other issues that are perhaps bigger dollar issues or more complicated issues. The other thing I'll just touch on quickly is we did get just a few days ago, the U.S. monthly sales results. And the thing we continue to see is that sales growth, while positive, continues to decline fairly gradually. And overall, the rate of sales growth is not keeping up with inflation. Now, we don't have a level of granularity to look at that on a category by category basis. But if you think about U.S. inflation being in the range of about 3 to 4%, sales growth being less than that, we're not seeing real growth. The two things I would point out in particular that we've highlighted, I know probably for close to a year, is how much the declines, how significant the declines have been in the more big ticket stuff, this kind of pull forward of appliances and furniture and all that kind of stuff. Those numbers are still relatively weak, but the declines are getting smaller. So perhaps we're getting closer to a bit of a pivot there. So we'll have to see. But that was an interesting kind of change and improvement in trend. And then the one
that's something you talked about actually last season, is that this doesn't last forever. I mean, the buy forward, that's a year, depending on the quantity, that's a year and a half, 2 years, but it's not forever, because eventually couches and things start to wear out. So maybe that's what we're starting to see.
Yeah, so that's maybe a glimmer of hope for those sort of businesses. Sure. And then the one that just is the gift that keeps on not giving are department stores. Department stores continue to be negative. We talked last year about how I thought the increase in department stores that we saw last year was really the proverbial dead cat bounce. This seems to be true. So we'll have department store earnings in, I guess, 3 or 4 weeks. So we'll see how that all pans out, specific to specific retailers, and I guess most importantly, specific to profits.
Yeah.
But I think
apparently
it's
Macy's is going to win on more relevant private label. I mean, there you go. So there's the headline from Macy's.
Hashtag thoughts and prayers.
Well, and then apparently the Best Buy, is it the Best Buy or Target new CMO wants to win by understanding customers, apparently. So.
Yes. But I don't want to blame, I don't want to get into this, but yes, sometimes when I just see some of these headlines that, Best Buy CMO wants to understand customers. Now, I'm pretty sure that was not what they said. That was whatever the editor
If only we understood customer. If only we understood customer.
What a concept.
We'd be doing so much better if we had a clue.
I wish I had thought of that. But I would have actually charged them half my normal rates for that consulting advice.
Friends and family rate. There you go. So I went to a fun event here in Toronto. The folks at Amazon invited me to a Prime Day event. It was a ton of fun. They had a bunch of influencers and media types, and they were doing kind of the Price is Right with Prime Day. So Prime Day gets a bit of, still, to my amazement, actually, gets a bit of excitement around the event. You and I share the same philosophy around these events, but why don't you, you saw some positive media, relatively speaking, but what does it really mean when you see Prime Day up % or whatever it was? What are you thinking?
Well, the thing that always annoys me about some of these reports is that they state that Prime Day was a huge success because sales were up, whatever. And the answer is we have no idea from outside whether Prime Day is a success. What I do know from my history of studying these events is that the better the event is, most likely you have pulled sales you would have gotten anyway from the days before or after, and typically at a lower margin. So you cannot write an article, or you shouldn't write an article that says Prime Day is this huge success without looking at the fuller picture. Because and I don't know, I don't have any idea one way or another whether Prime Day was a success. So I just think that we're intellectually dishonest to focus on sales on a particular day without knowing how, say, at least a week on either side panned out, and without looking at margin performance. There's other things that they're trying to do. I mean, obviously gets them a lot of press and those kinds of things. But just this sort of high-fiving around how obvious a success it might be, the simple answer is we don't know. I also think Prime Day and any of these events, I'd say I've said the same thing about Black Friday. They mean very little in the big scheme of things because typically it's a relatively small percentage of your sales. And again, it often comes at a lower margin. And so ultimately, if you're not looking at your total performance, it's very hard to know if it was a good idea or a bad idea.
The one thing I was thinking of for Prime Day that may be net accretive, so to speak, since we've got a BMO analyst on on the pod is the fact that they being Amazon earn so much from their third party sellers, and if they increase third party sales, again, notwithstanding all your thoughts around is it just moving the number around, they being Amazon earn not decreased margin from that. They earn the same margin from that because they're doing the services. So in other words, their services business benefits from the increased visibility on the site, so they're serving more ads, and then they get a little more juice from their third-party sellers. So I think, as you said, it's a complicated. Who knows if it was successful or not?
Right.
But just writing articles, it was a big success. Is as you say, intellectually. Yeah. I don't know.
Well, you also raise a good point without getting into a whole other tangent necessarily. But so much of the press. I'm not trying to pick on the press. I guess technically, we're part of the press. But Amazon is so often compared to other retailers. And the fact of the matter is, with retail, they make most of their money from, as you point out, third-party services and advertising.
Yep.
Which is not the model for most of their competition, even though some people are obviously trying to get deeper into marketplaces. And all kinds of things. So it's not even really an appropriate comparison in many cases because Amazon's trying to do something really quite different than most retailers. So not to fall into kind of old patterns or be too repetitive. It's just, these isolated events viewed just from the lens of sales performance is just a limited view. And, I'd rather see, their quarterly performance and how this all sorts out before I would declare it a massive success or even a disappointment.
Mirror, mirror on the wall. Lululemon cannot find a buyer. That doesn't rhyme, but I don't know where it's going.
Should have when we workshopped that a little bit more.
It works so well in rehearsal. So nobody wants this apparently thing.
Yeah, just to refresh folks' memories, Lululemon bought the Mirror business, which was a exercise equipment app for quite a bit of money a while back. Yeah. They took a big write down on that, and they've been trying to unload it. And yes, they so far have not been able to find a buyer, which is pretty staggering. And really one of the few examples I think we can point to where Lululemon has really had a big failure or disappointment. I think it was an interesting thing to experiment with.
Sure.
But it's turned out to be a failed experiment. So on the one hand, cutting their losses and moving on is something I generally
speak of often.
Generally encourage. But it's this surprising blemish, I guess, for a company that pretty much seems like they can't get anything wrong.
It's funny because my thought on that is the brand reputation is getting everything right, and if somebody's saying, well, even you guys couldn't figure this out, so there can't be much there. Like it could be working. Yeah. The reputation could be working against them. It's like if Lululemon can't figure this out, I'm not sure I can either. Kind of thinking. Anyway, making that up. Let's wrap up with the amazing actor that is Margot Robbie and her latest pick. I love Margot's work. I mean, she's such a variety of characters, and Barbie is getting great reviews. I mean, I saw the clips of it, and it's Barbie's world, and we're all living in it, so to speak. I think you wrote that, and the movie's getting great reviews. And oh my goodness, the executions at retail, it's pink everywhere, and I haven't seen anything done this well in a few years. What do you think?
It's wild. Well, to me, this is just as a great example of what I literally mean about remarkability. Let's give people something to talk about. And they have done it over and over again, and in a really genius way. And I suspect the movie is going to be amazing. But the amount of interest that they've been able to generate pre-release it's just staggering. And then there's this whole what do they call it, Barbenheimer? Because you get the Oppenheimer movie opening on the same day. So it's just amazing how you can kind of become part of this cultural zeitgeist and just create. Even if you weren't necessarily particularly interested in Barbie, but you sort of had me at Margot Robbie. Yeah. There's now it's like, well, I almost feel like I have to go see it to understand what everybody's talking about. So it's a pretty phenomenal study in how to create remarkability.
That was the news of the weeks, I guess I should say. Let's get to our interview. Actually, my interview of you and Simeon Siegel live at the LEAD Innovation Summit in New York City.
Good morning. Good morning, everybody. All right, we're here. Day one, morning one of the LEAD Innovation Summit 2023. Let me start by saying thank you guys for being here, settling in as we get started this morning with a wonderful session to kick off with. You know, for us at the LEAD, it's really a focus on the future of the direct-to-consumer business model. We think about all of the components of the value chain to really sell directly to the customer. It's marketing, it's e-commerce, it's stores, it's customer experience, it's last mile, and everything that fits in between, merchandising and payments, and everything that we need to think about to successfully grow revenue and increase profits in our direct business. So with that in mind, Simeon, I'd like to ask you to come up along with the panel. So we have Michael, and then we also have Steve. I'm going to turn it over to you guys to get things started. Have a wonderful conference, and I'll see you after the session is over.
All right, let's hear it for Noah. Noah, nice. Thanks for the intro. All right, everybody, good morning. So not only do we have the privilege of opening up the day here, but we're also recording this session for our Season 7 debut of the Remarkable Retail Podcast here live in New York at the LEAD Innovation Summit. So let's hear it. There we go. There we go. All right. All right. So let's get started. So we're gonna talk about this the scope here in kind of three parts. The first part is going to be a kind of a set the stage. Second part is kind of current set of what's happening, and the third is going to be more focused on the future. So, Steve, first question to you. Let's start with some definitions. Let's lay the groundwork here. When I say DTC, you say what?
It sounds like that was supposed to be a cheer or something that I didn't practice for. Well, so I realize there's a lot of confusion, and I think some of it is that people have often come to think of direct-to-consumer as e-commerce.
Yeah.
That's not the way I think about it. I tend to think,
we get some applause in the audience. Very good.
I sometimes, because any of you follow my work at all know that I can be a little bit snarky, I sort of say, well, DTC stands for direct to consumer, and so the definition's kind of like right in the name. Right. Selling things direct to consumer as opposed to going through wholesale. So two ways of distributing. You sell it to somebody who resells it. That's the wholesale model, or you sell it directly to the consumer, whether that's from your website or in your own stores. Stores can be direct-to-consumer. E-commerce can be direct-to-consumer, but not all e-commerce is direct-to-consumer, if that makes sense.
Simeon, do you think of it similarly, or do you think of it in any different way than what Steve just articulated for us?
It's hard to argue with a dictionary, so I will join Steve in that. But I think it's become something that has been perceived to be something that's so much more. So I think the kind of we have this conversation all the time, and I very much agree. That's what direct-to-consumer means. I think people's perception of direct-to-consumer is that it became an identity as opposed to a way to sell. And so I think ultimately a lot of these conversations, I mean, we've talked a lot about some work my team did several years ago. We called it D2C is not all it's cracked up to be. The premise was not D2C is bad, it's that wholesale's not bad.
Right.
And so I think that's this idea of like we have terms that we focus on, but at the core, what we care about is the business.
Yeah, and I want to get back to that later in our discussion. Steve, this is in no way meant to be a history lesson, but it some days feels like DTC is kind of the latest thing, but it's not really the latest thing. Talk about a little bit about your perception of how long the DTC model has been around.
Well, pretty much forever. I mean, being the old guy in the room, direct-to-consumer, started really back in the mail order catalog days, and that was really more direct marketing. In some cases, it was multi-brand, but there are a lot of famous brands that are direct-to-consumer that have been around for a long time. J. Crew, Banana Republic, Land's End, LL Bean, et cetera. I mean, these are sort of the classic direct-to-consumer brands. I sometimes kid around. I call them the analog native vertical brands because they were started a long time ago. For the most part, they were fully integrated like some of the DNVBs are. So yeah, it's an old business model. I think Insider Intelligence recently did a report that showed that kind of the old school direct-to-consumer brands are actually like 3 times as big as this newer age of direct-to-consumer brands. So not only have they been around a long time, it's quite substantial, and most of them make money, which is kind of a nice feature.
Can I jump in on that for a second? Because
Yeah.
I think this is like so important. We have perceptions of size, but we actually have a metric that tells us size. It's called revenues.
It's funny.
And it's mind-blowing. And it's like we think about all the disruptors. If you think about, take your picture of your mental picture of who the disruptors are, and then think of who the dinosaurs are. The dinosaurs are drastically larger businesses that are still making money.
Right, yeah. The other thing I think just mentioned from a history standpoint is that, you know, it's been funny to me, and I'm sure I'll offend at least a few people in the room, but when some of the digitally native vertical brands started to say, I wonder if stores would be interesting, I was like, well, pretty much all those that came before you figured out that you were limiting your total addressable market. I may come back to that point in a second, or a little later question. By not having stores, there's some economic benefits of it. And then the other thing, which then became kind of a talking point at conferences 5 or 6 years ago, was, whoa, when we opened stores, our e-commerce business went up. Right. And I'm like, yeah, well, if you talk to anybody else who's been in the business for 30 or 40 years, you know, that's Williams-Sonoma's experience, that's Sur La Taub's experience, et cetera. So, you know, in some cases, there's a lot. I mean, obviously, there's a lot that's different about starting digitally and having a very different kind of business model and so forth. So I'm not trying to say that that's not innovative or different. Yep. But a lot of the things that are driving the way we think about the newer DTC brands are actually things that the old DTC brands have been doing for decades.
Yeah, and it also gets into the discussion around cannibalization. So we're not going to dwell on that, but, you know, and you've often said you might as well argue about gravity than argue about cannibalization. Simeon, do you even think of DTC as a business model, or do you think of it as something inherently different than that?
You're taught never to literally go against the title of your presentation, which I think says the D2C business. No, listen, I think that...
Throwing it down. I'm throwing it
I
out
think
there.
Since the beginning of time, there are creators of content and IP. There are distributors of content and IP, and there are users of content and IP. And that IP can be a jacket, it can be a song, it can be a food, it doesn't matter. Someone creates, someone distributes, someone uses, and those someones can be multiple people and they can be the same. And I think what we need to remember is if you're the creator, it's your job to get the consumer to buy and use. Figuring out the many ways to do that is part of your job. And certain times it's going to be more beneficial to do it by yourself. Certain times it's going to be more beneficial to let someone else do it. I think something that's so fascinating, and again, most of you who know me know I like numbers, department stores, and again, I rarely ask who's in the room, so if I say something about you that you don't like, please throw something at me, that's okay. But department stores, specialty apparel retailers that sell other people's things generally have low gross margins. That means they have high cost of goods. Their cost of goods is the brand's revenue. Third-party retailers are very economic. They're very economically efficient ways to distribute product.
Right, right. Steve, notwithstanding DTC has been around for a long way in its various formats, so there is more energy around DTC. You
Sure.
said, I
Right.
mean, you said digitally native vertical brands, for example.
Right.
That's at least the terminology is more recent. What do you think's behind that kind of I wouldn't say re-interest, but that kind of focus and energy around digitally native vertical brands and the business model itself?
Well, I think D2C more broadly, not just the DNVBs. Well, there's a lot of acronyms here. So I think there are 5 reasons. We'll see if I can remember all 5. I may have to check my notes. I think the first, particularly if you're looking at manufacturers' interests, so whether we're talking about Nike or Columbia or whomever, wholesale channels generally, while still huge and important, have been going through a lot of turmoil. You know, if you think about department stores and some other big box retailers, there's been a contraction in the number of stores, and there's been a lot of bankruptcies. So the points of distribution have been shrinking. I think there are a lot of concerns about the execution, how brands are represented in wholesale relationships, whether that's too much price promotion or shoddy standards or what have you. So I think there's just this concern that wholesale is contracting or the brands don't like how their brand is being represented. I think the second thing is just technology has changed things. My ex-wife worked at Kraft Foods for many years, and one of her big complaints was her customer was the grocery store, not the end consumer, even though they did all the marketing to the end consumer. But as a practical matter, other than doing like recipe contests and some other things, they had no way to reach and interact with that end consumer. So technology now, whether it's e-commerce or just other ways, allows brands to bypass and have that end relationship. So, which leads to the third thing, which is that's incredibly powerful, right? To know who your end consumer is, to be able to target them with promotions, to have the data to leverage for your strategies, et cetera, et cetera. I think the next one is control of the brand. Like I said, I think people have gotten more concerned, or brands have gotten more concerned with how their brand is represented at retail. I worked for Neiman Marcus for many years, and a lot of our vendors were starting to open their own stores and starting to go to e-commerce, and a lot of that wasn't so much that they didn't like how we were doing it or Saks was doing it or whatever, but they wanted to elevate their brand, have a wider assortment, be able to control the environment and feature it more prominently. And so that's potentially of strategic value. And the last one, which is probably the most powerful one, and then I'll shut up and let Simeon speak to this because he's done so much work on it. I think once you could do it, there was this belief that, well, if it costs us 20, just to use a simple mathematical example, and I know you were told there would be no math, but I'll keep this simple. If it costs you $25 to make something, and the consumer ultimately pays $100, well, you can sell that to the department store for $50, and then you turn around and sell it for $100. You make $25. If you're like, well, if I can go direct to the consumer and I can get the $100, then I make $75. That sounds like it could be better economics, which sometimes it is, but I think is a lot of the work you've done. People sort of gloss over that there's a lot of investment and costs that go along with actually realizing that. That's the gross margin. It's not the bottom line.
And Simeon, let's pick up on that thread, because you wrote a seminal report a couple of years ago, you and the team, around that it's not always, the math isn't always so straightforward, that the math just articulated by Steve doesn't always work that way. Now, you've iterated on that report ever since. You had identified certain retailers and certain phenomena. Just for those who may have missed it, what's your current thinking on, hey, listen, I can make a lot more money by just going direct? As something changed in the environment over the past 10 years as well that makes it a little harder to capture all those dollars?
So first off, thank you for referencing that it was my team. This was wildly a team effort. There was a lot of work involved. So at its core, we're trained to think about gross margin unit economics because we think that scale eliminates all the other costs. When the cost is intrinsically linked to gross margin, it's just called OPEX. You have to account for that too. And so what I mean by all of that, so kind of as we've iterated on this report, what we effectively have synthesized it down to is, and I'm going to use made up numbers that aren't real, but by going direct, to oversimplify, you keep all of your product margin, but you also absorb all of your operating expenses. If you're a store, that's rent and labor. If you're e-com, it's pick, pack, ship, fulfill, return, reverse logistics, keep on going, right? Whereas if you go wholesale, you're agreeing...
And drive traffic too, right? Let's not forget about the front end. The cost you're going to have to put in to get people to do
this
all
higher
those
marketing
things.
Yes, exactly.
Right.
If you're wholesale, what you're effectively agreeing is I'm going to share that $25, right? I'm going to share that $100 ticket. Let's say I'm going to share half of my product margin. But in response, I'm basically going to walk away from the vast majority of my OPEX. And so to use simplified, incorrect numbers, if I agree to give up half of my product margin, and if I have a 30% operating expense ratio, I need to start with a 60% product margin to simply break even. Now again, these aren't the real numbers, but it's the way I think about it. And so a company like Lululemon or Coach that has these beautiful built-in product margins that are real, not played around with, that are real, straight up, beautiful margins, yes, they might want to keep that product margin. They might not want to go wholesale. But almost everyone else will find that the cost of driving that business is better given to a Macy's or a Foot Locker or a host of very productive businesses. I think that's the simplified, that's where I've gotten to over the last few years that have embellished on that DTC is not all it's cracked up to be. And so it's this idea that there is no broad brushstroke. You have the numbers, they're there, use them. I know common sense feels powerful, but it hasn't aligned, because how many of us 10 years ago thought e-commerce was going to be this wildly accretive channel for retail, and yet, not really.
Well, let's pick up on that theme, Steve. We're kind of, in some ways, we're in the second iteration of the dot-com era, broadly speaking. If the first integration collapsed in the dot-com bomb, 99, 2000 kind of era. And it kind of led to this idea of retail disintermediation.
Right.
And that led itself to the kind of this canard of a false narrative around the retail apocalypse.
Right.
Where do you see that today, and how do you see that evolving, at least in the perception about the retail apocalypse? Or spoken differently, sometimes we see stores are back, whereas we've often said, well, they never really went anywhere. Not that we're all about stores and we're not the biggest store advocates, but talk about that for a bit.
Well, one way I've thought about this is I think if you go back to the investment premise for the second round of the pure online retail players, whether it's digitally native vertical brands or some of the other disruptor brands, I think there were two, using Scott Galloway's term, consensual hallucinations that investors and entrepreneurs had. One was that you could build very big brands online only. And so I think that the total addressable market that a lot of these investment premises started on was just wrong, because it was predicated on this belief of a massive shift to online that hasn't occurred. What will go down as the stupidest, this is not being recorded, right? This is going down as the stupidest prediction ever in retail, is Mark Andreessen, who's a smart guy who has a lot more money than I do, said in 2013, there will be no stores in the future. Now, he didn't specify a time, so it still could happen.
Yeah.
But since he said that, physical retail has grown every single year. 50,000 stores have opened. Last year, more stores opened than closed. So we now seem to be on the trajectory to physical retail going away. So there was
even after the disruption of the COVID era, where stores were shut down.
So I think this just general idea that you could build these on the revenue side, these very big brands without stores was just flawed. It turns out people like stores. It also turns out that the economics of stores often are very accretive. The second thing, I think, which gets a lot to what Simeon was saying, is, well, yeah, you can capture that 70% or whatever gross margin, but the cost of building the brand turned out to be way more expensive than you thought. And there was actually some false proxies in the beginning. I worked with a couple of these DNVBs 10, 12 years ago, and some of you in the room probably experienced this, where you had this massive growth, relatively low cost of customer acquisition. Well, some of that was because you were tiny. It was all driven by organic. But then, instead of customers finding you had to go find customers. And in most cases, I'll just use Bonobos as an example. This is not real data. This is sort of a premise. But Bonobos, I think, probably discovered that, well, the customers we need to acquire shop at Nordstrom, let's say. Well, so we have to give them a deal to switch and keep, activating them. And so it became, and we're competing with them for keywords and things like that. So the unit economics of it turned out for a lot of these brands to be very, very challenging. So I think there were these just two fundamental, the size of the opportunity for many, not all, and the underlying economics. So now we find ourselves in a situation where many of them are looking at wholesale as a way to hopefully improve their economics, or looking at their own stores to try to get the business to a profitable place.
I think there's two very important points in what you just brought up. I think there's a premise that brands believe their customers are more loyal than they are. And I think there's the belief and the premise that scale solves all. And I think that scale will solve fixed costs. It will not solve variable costs. It sounds simple. It's always overlooked.
Simeon, are we at an inflection point here in DTC? Are we even asking the right questions? Or what are the right questions to ask as we look at this model as it evolves, or this channel as it evolves, or however you want to phrase it?
So I don't know if there are VCs in the room. I think every VC would say we're at an inflection. So I think from a capital, and I think any brand that needs to raise money would say that we're an inflection. From a capital perspective, the answer is an absolute yes. From a business perspective, I think the answer should, this is retail. We're an inflection every day. If you're not finding an inflection, you're probably not doing the right job. So I think the same way that I say D2C is a way to sell to your consumer, I think, and I'm curious if you agree or disagree, I think we're always at an inflection. And I think that sometimes whatever the mother of all necessity, innovation, whatever that phrase is supposed to be, apply it and re-edit it for the podcast, please. But at the end of the day, without capital that was irrationally given, people are going to be forced to find businesses that are more rationally equipped.
Steve, you've been talking about the, what did you call it, the profitless prosperity of some of these brands. Where do you, picking up on Simeon's inflection point, where do you see this happening? We already see some brands deciding pretty quickly to go into stores as well. That's not new, but it's also not exactly solving the entire issue either. How do you think of this?
Well, just quickly, I think it's become pretty clear. I mean, not to make it all about the stock market, but some very high-profile brands have had 70, 80, 90% decrease in their stock prices. Difficulty raising capital probably if they need to, and they're not on a glide path to profitability. So, something has to change, whether that will turn out to be that stores will be the thing that will help them, whether they can rationalize their business in a different way, leverage wholesale more to get their marketing costs down. I mean, I don't think there's one answer for each brand.
And it's pretty hard for let's say, a digitally native vertical brand team to suddenly pivot and become a 300-store operating team. These are fundamentally different.
Well, first of all, you got very different investment characteristics, different skill sets. So absolutely. I think the other thing, too, it's really and this is probably a whole other thing, I'll just mention it briefly. I'm not sure that some of these store plans are going to work out for many of these retailers. There really aren't that many of these brands that have more than a handful of stores. And it's one thing to open a store, up the street here when you got great density. It's another thing to go to the Frisco Mall, near where I live in Dallas, and have that store work. So I think it's a lot of challenging, aside from the headwinds in the economy and just a bunch of other things. I don't think it's clear that physical stores are going to necessarily be the thing that are going to suddenly turn around some of these brands that have real profit challenges.
All right, last words. We're almost at the end of our time. So it's a pretty important week, actually. We just had probably a pretty big retail day yesterday, collectively, between Amazon Prime and all the follow-on sales and promotion from the big retailers. Steve, I'll start with you. 1, 2 things you're thinking about now for the rest of the year and into 2024.
Well, unfortunately, I think for most retailers, the next year is going to be a lot tougher than the past 12 months. And so, and there's a lot of just volatility and uncertainty, interest rates, where is inflation going to go, war in Ukraine, climate change, just a lot of things that make it hard to predict how things are going to go. But I would generally say things are going to be tough, so you really got to focus on those efficiencies. But, and we talked about this on a podcast episode a few weeks ago, I think the counterbalance is don't get so focused on the short term that you lose sight of the long term. Because if your business proposition's not, to use my term, remarkable enough, you've got to be investing in innovation, and usually that doesn't pay off quickly. So I think it's a real, if you are one of these retailers that's really pressured to get that right balance between the short term and keeping that innovation pipeline going, I think that's a real challenge.
All right, Simeon, last words to you. What are you thinking about, and what should we be focusing on?
I think in the spirit of this topic, I think let's realize there's no good or bad channels. There's good or bad partnerships. You're referencing Prime Day. There's a lot of traditional brands, some that we've mentioned, that are now on Amazon in a way they weren't. I think Amazon's main press release flagged The Gap and Victoria's Secret, among others, as being prime deals. So we're watching the willingness to embrace, focus on the partnership. It's not universal. And the second thing I would say is, remember what makes you special. And I know that sounds absurdly boring, but it's true. I think when you had D2C as the business model perspective, you didn't have to be as special. I think right now, when you have to earn that customer dollar in a different way, and therefore you get to keep it in a different way, it's more sustainable, remember what your brand represents. And I think during COVID, since 2008 until 2020, you lost pricing power. The customer won that game of pricing chicken. 3 months at the end of 2020, the brands took it all back. Don't give that back. Don't just chase promotions because the macro is a little tougher and we're simply on the other side of COVID. Easier said than done, but if you can trust what makes you special and retain that brand equity, that ultimately is the most lasting, powerful thing a brand can have.
Well, gentlemen, wise advice, great conversation. Couldn't think of a better way to kick off the day today. I hope everyone has an amazing day, and by all means, smash that subscribe button, our code there. Remarkable Retail Season 7 debuts July 25th with this episode, and we got lots more coming on. So, Steve and Simeon, thanks so much for joining me on our stages, and everyone have a great rest of your day.
Thank you, guys. That was a bit of a masterclass in the future of the direct-to-consumer business model. Wonderful.
If you like what you heard, please follow us on Apple, Spotify, or your favorite podcast platform so you can catch up with all our great episodes, including our recent interview with Carrie Baker, President, Canada Goose. And be sure to drop us that 5-star review where you listen to your podcast. It really helps us spread the word.
And I'm Steve Dennis, strategy and innovation consultant, keynote speaker, and author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me at stephenpdennis.com, and be sure to follow me on LinkedIn, Twitter, and Instagram.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer and host of a series of retail trade podcasts, including this one. You can learn more about me on LinkedIn. Safe travels, everyone.